What you're looking at is a bubble, but not just any bubble, the AI bubble. Startups with no revenues are getting hundreds of millions of dollars in investments. GPU orders booked till 2026. And big tech is swallowing entire sectors just to stay alive. Every chart vertical.
NVIDIA. Can't stop, won't stop.
Every headline identical. Same sense that this is a once-in-a-generation shot. Because the last time hype moved this fast, it detonated the markets and rewrote the rules. But this time it's different, right?
If you're not engaging AI actively and aggressively, you're doing it wrong.
Domino 1. Is history repeating? The AI boom didn't start with a product. It didn't start with results. It started with money. Before the models worked, before the use cases were proven, capital moved. In 2024 alone, $30 billion was poured into generative AI. VCs were treating AI like a guaranteed monopoly. Why? Because they've seen this movie before. Back in the 90s, stocks with no earnings and unproved business models went public. 370 tech companies went public. Only 14% were actually profitable, much like today. Back then, you didn't need business models, just a website and a dream. Pets.com raised $82 million selling dog food online. Today, AI note-taker clones raise millions for identical features. Investors line up for anything with AI in the name. And just like last time, it felt easy. Money was cheap, risk was optional. And the goal wasn't to build something real, it was to get in early, ride the wave, and exit before the music stopped. But here's the twist. .com was built on websites, light, digital, almost weightless. AI is built on something different, real-world infrastructure that's already starting to crack. And that's where this bubble stops being just financial. Domino 2, the bubble accelerates. Big tech saw the gold rush coming, and they did what they always do. They built fast. Amazon, Microsoft, Google, all of them pouring billions into data centers like adoption was already guaranteed. Microsoft commits tens of billions. Oracle accelerates its build-out. Amazon locks land before competitors can. This wasn't speculation anymore, it was preparation. Once the money moved, there was no exit. You don't commit tens of billions unless you're already all in. This wasn't testing AI, it was locking the future in place. Land, power access, supply chains, long-term contracts. Those aren't bets, those are obligations. And once those obligations stack, the system stops asking whether this works. It starts demanding that everything else bends. Permits stall, transformers don't arrive, and data centers sit there, finished on paper, waiting on power.
That Intel's Ohio 1 plant under construction in New Albany is facing an uncertain future today in its second quarter earnings report.
But the spending, it already happened. The promises already went out. That's not growth, that's pressure. And the pressure doesn't disappear, it transfers. Domino 3, Wall Street's pressure point. Here's where the loop tightens, because Wall Street already decided the AI boom is real. And once the street prices in hype as guaranteed growth, the machine locks, and there's no room for error. NVIDIA hits $4.5 trillion valuation. Microsoft stocks surge. One sector propping up the entire market based on hype that hasn't shipped yet. Every shareholder, every pension fund, every 401k already made their bet. And everyone's stuck. Everyone scrambles to justify the price.
Look, I think what it goes to show is data center demand is off the charts, and that's what the guidance shows as well.
You spend ahead. You book capacity you don't need. You burn tomorrow's revenue to protect today's price.
That productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks.
Because once expectation is this high, missing it doesn't look normal. It looks like failure. Now every company in the ecosystem is spending future revenue today, chasing growth that's already priced in. Because walking it back would break everything they're standing on. This is what turns a normal cycle into a bubble. Not belief, but expectation that can't be disappointed without consequences. By now, the bet isn't optional, it's systemic. Domino 4, when reality misses the timeline. Here's the part everyone's been thinking. What if demand never catches up? Because right now, startups are burning through VC money faster than ever. Anthropic, burning billions. Inflection collapsed, absorbed by companies with deeper pockets. And OpenAI still doesn't have a pricing model that covers its own cost.
What is the path to profitability? When do you see the lines cross, if you will?
That pause speaks volumes, but around here, he admits.
The rational thing to do is to just be willing to run at a loss for quite a while and continue to do that.
Everyone promised enterprise use cases, AI agents, automation, productivity gains. But those use cases still being tested, still unreliable, still not justifying the billions being invested. And that's when demand slows. And when demand slows, but your costs are locked in, you're trapped. Big tech already spent next year's earnings to get ahead. Now they need AI's revenue to show up now. The real twist. At this point, I get it. Most people reach for the same comparison, the dot-com bubble. And on the surface, yeah, you're right. It looks familiar. Too much money, too much hype, too many promises. But that's the wrong model. Dot-com blew up in public. Retail piled in. Companies IPO'd with no revenue. And when it snapped, everyone watched it happen on the screen. AI isn't built like that. This time, the risk isn't sitting in your brokerage app. Most of it is parked in private capital, VC funding, hedge funds, closed-door commitments. The public can't even invest in most of it. If an AI startup dies today, your 401k doesn't blink. No headlines, no panic. Just a quiet write-off from private capital. But that's what makes this even more dangerous. Because when the risk is hidden, it doesn't disappear, it moves. And this time, it doesn't move through the stock prices, it moves somewhere else. Somewhere even more personal. Domino 5. This isn't the dot-com bubble. Everyone expects this to end the same way. A sell-off, a correction, a climatic crash. That's how dot-com ended. But that's not what this is. Dot-com collapsed because the public was exposed. Retail piled in. But this time, the risk never made it to the public. It stayed private. VCs, mega funds, balance sheets you don't see. And that changes everything. Because in 2000, the weakest companies collapsed first. This time, the strongest ones are betting the hardest. Microsoft didn't wait to see if AI works. They built for it. $13 billion in OpenAI, $100 billion in infrastructure, and years of locked-in commitments. Google, Amazon, Oracle, they're all the same game. Back AI or fall behind. That's the real break from the dot-com. This time, when the math breaks, it doesn't show up on a stock chart. It shows up in stalled projects, delayed rollouts, and systems that can't expand when demand hits. The risk didn't vanish, it just moved off the charts and into the real world. Domino 6, the world pushes back. AI needs space, cooling, transformers, and most of all, power. And suddenly, no one had enough of it.
But I actually think before we hit that, you're going to run into energy constraints, right? Because I don't think anyone's built a gigawatt single training cluster yet.
High voltage transformers backlogged, utilities pushed back, cities saying no, land dried up, cooling systems buckled, communities started fighting back. Virginia slows approvals, permits dragged into court, projects stalled mid-build. The money assumed AI would scale on command, but the people, they're tired of the impact.
So you can see the sediment from the data center. Wow, and that's just from the water coming out of your faucet.
Yeah, and this is what's in all the pipes.
And that's when the system bent. Now you got $100 billion projects waiting on parts, GPU orders back for years, and Wall Street already priced in the payoff. This isn't a race to scale, it's a race against reality. Because when the infrastructure slows, but expectations don't, something snaps. This isn't a hype bubble sitting on tech stocks, it's a cost bubble built into the physical economy. Power plants, data centers, energy grids, long-term contracts, infrastructure sized for demand that hasn't arrived yet. And that's why it doesn't pop like the dot-com bubble. Because once the infrastructure is built, you can't unbuild it. The costs don't disappear. They don't get wiped out in a sell-off. They get transferred into your power bill as data centers drain energy. into your job market as overspending turns into layoffs, and into your retirement when pension funds and index money are forced to absorb the losses. Because the only way to keep this system alive is to keep pushing the cost downstream to everyone who never asked for it. That's how this bubble pops, not in a single moment, across an entire system. So, what's the lesson? Bubbles don't die, they transfer. The dot-com didn't end tech. It cleared the junk and gave us cloud, mobile, and e-commerce. In 2008, it didn't kill finance. It rerouted cash into SaaS and big tech. And the AI bubble, when it bends, it won't be the end of anything. Because bubbles aren't just prices inflating, they're capital re-evaluating, desperately searching for the next system strong enough to carry the future. So if AI is stretching the grid, the bubble moves to energy. If AI is choking on compute, the bubble moves to hardware. And if AI is burning through capital, the bubble moves to companies that can provide that efficiency. The money won't disappear, it'll move fast into the next thing that looks like innovation. That's the real game, positioning. Because when a bubble pops, the losers fight over the ashes. And the winners, well, they've already moved on. That's the way it's been throughout history. That's the way it's been for over 100 years. And that's the final domino. The next domino is already loaded, I think, unless I haven't made it yet. Anyways, it's called the 100-year bubble. How debt, assets, and trust got stretched across a century, and what happens when it finally snaps. Whether you're subscribed or not, thanks for staying to the end. I'll see you in the next domino. Until then, peace.